Well, I don't know that we can rely on it just yet. I do think that over the next couple of weeks, Scott, we are going to see some rotation back into equities, and particularly into U.S. equities. Just think about where we started the year. If you had a traditional 70-30 or 60-40 portfolio, you're definitely off that mark for your equity weightings now. Many people came into this year bullish about international and emerging market equities, and although they'd had a nice rally last week and recovered some ground, there is a little bit of skittishness in terms of what the potential spillover from the situation in Ukraine could be on Europe in particular. Think about supply chain constraints. And so I think over the next 2 weeks, I do think we start to see a little bit of excitement about U.S. stocks again that could go down into small cap stocks as well. That might not just be limited to large caps. But I think in terms of sustainability, I think we want to make sure that there isn't additional spillover from a geopolitical perspective. I think 5 rate hikes sounds a lot better to the market than 7 rate hikes. But I also think that you're seeing in the curve, in the bond market, you're seeing some concerns about recession. You're seeing the flattening of the curve. You're seeing concerns about growth. If we're back to, say, 3% growth from a GDP perspective by the end of the year, that's actually not that bad compared to where we were pre-pandemic. And I think people are getting overly concerned about growth in the market, but I think this next 2 weeks probably looks a little bit better. We might see some skittishness as it relates to the geopolitical situation as we go into the summer. Most importantly, CPI, PPI. We saw PPI get a little bit better last week. I think that's what we need to see is continued improvement, that the trend in inflation is coming down, energy prices fall below $100 a barrel on WTI. Then I think you get that inflection point, Scott, for the markets in the second half of the year.
Doc, you know, there's the interest rate complex today, 202 on the 2-year. I'm only 21 bips behind the 10-year at this point. What are the options traders betting on, Doc? What are you seeing in terms of being able to answer the question of whether the rally is reliable or if it's simply a bear market bounce that feels great but is soon to evaporate?
Well, Friday, Scott, you and I talked about the LQD. That's, I think we talked about it. That was the high yield, the corporate high yields, and they were buying downside puts in there at the 118 strike with that at about 121.5. We've dropped back down into the 120 level for that LQD. And so what is that telling us? That's telling us that people are anticipating higher rates for everybody, corporates as well as Joes and Janes. Obviously, mortgage rates had a pretty big jump last week, and maybe that's an understatement, pretty big jump. And that may start to erode some of the gains that we've seen in housing as they become less affordable to those that are seeking an 80-20 traditional kind of mortgage, 20% down. And I think overall, though, Scott, Shannon's right. The market is sanguine. The market is feeling, you know, just sort of even-handed right now. An awful lot of our equities, I'd point to, that are owned by overseas players. The United States is lucky that we have so many investors from overseas, both institutional and public. I mean, I believe that the last count I saw, which unfortunately was 2019 to 2020, Scott, showed that almost 40% of our equities are owned by overseas entities. The reason that's good is that these people are not looking to put that money back into Europe, and certainly not looking for some of the war-torn areas of the world to invest in. They're instead hunkering down in our equities, and I think that continues to sort of be that floor, if you will. It's not the same as a Fed put, but I don't think those folks that are in there for anything but the long term at this point. I think Europe has proved to be sort of what we've said all along. You don't have the liquidity when you want it or need it in Europe, but you do have it almost 24/7 in the United States.